Hello, and welcome back to the Flipping Junkie podcast. Today, I've got Paul Moore on the show. How's it going, Paul?
Hey, it's great, Danny. Thank you. How are you?
Yeah, doing just fine. Let's see. So, for the audience out there that hasn't heard of you, and I think most people have heard of you, but if they have not, after a stint at Ford Motor Company, Paul co-founded a staffing firm where he was a two-time finalist for Michigan Entrepreneur of the Year. And after selling a publicly traded firm, he began investing in real estate. He founded multiple investment and development companies, appeared on HGTV, and completed over 100 commercial and residential investments and exits. And the main reason why I wanted to have Paul on the show is he also deals with storage units and different investments like that, and some of the commercial aspects of it. And so I was interested in finding out that transition from going to from residential real estate into some other avenues there for investing. And let's start, Paul, with your story. Why don't you share from your perspective what it was like from the beginning of your real estate investing and transition into commercial and things like that?
Yeah, absolutely. So I sold my company to a publicly traded firm in 97, moved to the Blue Ridge Mountains of Virginia, and I thought, I'm an investor now. And truth was, I wasn't an investor. I was actually a speculator, but I had to get outside of speculating to know I was. Mm-hmm. And so I did a lot of dumb things. I lost a lot of money, dumping money into speculative stuff like trading futures and a big hole in the ground they called an oil well that had no oil in it, and other things. So I learned a lot of painful lessons in that, but actually started flipping houses here in Virginia. Then I flipped dozens of houses. I got my real estate license. I started a website that's still going strong 17 years later, that generates leads for realtors. That's been a lot of fun. I actually started flipping lots at Smith Mountain Lake, which is a resort lake near here. And in all that, I didn't realize that I thought of myself, as an investor. And then I thought of myself as a serial entrepreneur. I thought about putting that on my business card. And I didn't know that I was really chasing shiny objects. I probably did half a dozen other things I didn't mention, including, lease options sandwiches, build to rent, some other things in there, built 7 houses, did a small subdivision. And in that whole process, I didn't realize that I was an entrepreneurial investor. And what I mean by that is it's sort of like being a shiny object chaser. I wanted to bring the excitement of being an entrepreneur into my investments. And by doing that, I actually lost a lot of ground, and I probably lost a lot more money than I should have than if I would have stayed in my lane. But that's something we can chat about later in the show if you want. Anyway, I went from there. I built a multifamily property, sort of a quasi hotel with a business partner in North Dakota. Then we did another one. Then he went on to do a Hyatt hotel. And I decided, once I learned the magic value formula, as I call it, for commercial real estate, I realized I wanted to stay in commercial. And so I basically decided I wanted to be a multifamily syndicator. Did a lot of intense work on that, ended up writing a book on multifamily investing that's still selling pretty well today, and jumped into that. To kind of round out my story here, after 3 or 4 years of banging my head up against the wall through the mid-teens here, I finally decided multifamily, like single family right now, is largely extremely overheated. And I think the experts, guys like you are, and your people in your mastermind, they're getting the real deals, while most of the folks who are not the experts with the deep systems and things are probably getting the scraps. And it's the same in multifamily. I mean, most of the deals that we heard about were through brokers, but people getting the best deals were getting those, off market with a systematic approach to finding those deals. And so we finally decided, hey, we want to find another asset type that's got more meat on the bone, has a lot more mom and pop owners that are willing to sell, who are aging out. And we found that in self-storage. And we also found that in mobile home parks. Just quick overview, there are about 53,000 self-storage facilities in the US. That's about the same as Subway, McDonald's, and Starbucks combined, but about 3/4 of those are owned by independent operators, and about 2/3 of the independents are actual mom and pops.
Wow.
And they typically don't have the desire, the resource, or the knowledge to maximize income and blow up the value for investors. And so acquiring an asset like that from a mom and pop seller is a incredible key to creating value for investors. And we've done that both in self-storage and mobile home parks. But I will say, just before I round out my story here, that our company, we learned in this process that you really need to be a deep expert, and you need to be kind of a systematic, I will call it a boring type investor to do that really, really well. And so we decided to actually invest with operators. Our goal became to find the very, very best operators we could in these different asset classes. These best in class operators often are not the most promotional, not the best money raisers. And so we've been seeking them out for a number of years now. We have done 4 funds. We're launching our 5th fund this week. And our funds basically allow accredited investors to invest with us. And then we spread that money across a lot of different self-storage, mobile home parks, occasional apartments, and occasional light industrial projects. So that's what my company, Wellings Capital, does right now. That brings us up to today.
Nice. Well, thanks for sharing your story. And, you caught me off guard when we got on this call, because one of the first things you said was, a lot of people find me to be boring. And I'm just thinking, well, well, how are we going to have an interview here where I don't fall asleep and the audience doesn't fall asleep if you're really such a boring guy? But and you started sharing your story, and here at the end, you've kind of explained what you were talking about by being boring. You gave a little taste of that, but I was thinking at the beginning here, like, this is anything but boring. Like, you've done all of these incredible things, all these different things, but you also showed that doing that may have been exciting and entrepreneurial, but wasn't really giving you the success that you were hoping for. So why are you now, so, as you say, considered boring?
Yeah. Well, I mean, so entrepreneurial investors, folks who, love the thrill of the chase, and they always in startup mode. They're kind of imitating Elon Musk or Jeff Bezos. They're excited about the next new shiny object. That was kind of my modus operandi for years. And operators like that often end up burnout, tired, spread too thin. And when I read Gary Keller and Jay Papasan's wonderful book, The One Thing, I realized, that's me. I don't want to be spread in all these different directions. Gary and Jay said, the man who chases 2 rabbits catches neither. And I realized that I was really a shiny object chaser. I mean, I was going for the next big, exciting thing. And I heard of people who were just investing, plodding along, buying up single family or multifamily in a small town. And they never got famous. Nobody ever wrote a book about them or made a documentary about them, but they were some of the wealthiest people in town. And I realized that these folks were truly investing. Investing is when your principal's generally safe and you've got a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. And, that people think about, the risk reward ratio. Low risk leads to low reward, and that's pretty well established. High risk leads to, people think it's high reward, but it's not. It's the possibility of high reward, but also the possibility of losing a lot of money along the way. And a lot of people who swing for the fences, like I used to, they end up to be the wealthiest developers on a few deals, and then they end up driving a pizza truck for Domino's a few years later when they hit, bad times. And I just, I'm in my mid 50s, and I decided that wasn't fun anymore. And so I also started studying Warren Buffett, and I realized that he is pretty boring. I mean, the guy spends 6 or 8 hours a day just with his nose in documents and reading, 5 or 6 newspapers a day and reading through company reports, 500 pages a day. The guy has had an incredibly boring life, but he's become one of the wealthiest people on the planet and the greatest investor of our time. He doesn't generally swing for the fence and swing for grand slams. He generally is a great investor. And I decided that's what I wanted to be. And our company, that's the kind of people we attract at Wellings Capital, people who are not looking for grand slams, doubling their money overnight, but we're looking to hit singles and doubles now. And like I said, it's a little boring, but it's actually a lot more profitable. And it's especially profitable when we become a deeper expert in one thing, like Jay Papasan and Gary Keller talk about, rather than having a wide variety of knowledge on a lot of things, but not having a depth of expertise in any one thing.
Right. Let's unpack that so that, there's practical implications for people as far as, let's just focus on self-storage.
Sure.
Right. So becoming the expert in self-storage, why self-storage? What are the benefits of moving into self-storage?
Danny, I got to say, you just brought up one of the most boring topics on the planet. Self-storage. Think about it. So we hear about value adds in multifamily. We think about, like tile and cabinets and countertops and new appliances and light fixtures and flooring and doors and all these wonderful, exciting things, a dog park outside, things like that. Where in the world are you going to get value adds in self-storage? We're talking about 4 pieces of sheet metal, a floor, some rivets, and a door. And it's not a very exciting asset class, you would think. But what we did find after we looked into it deeper is there's probably more value adds in a typical self-storage deal right now than there is in multifamily. Here's one of the reasons, and I touched on this earlier. 93% of large multifamily properties are owned by companies who have already wrung the value out of those multifamily properties. You go in and all the value add upgrades are done, and the rents are already at par level and the cap rates are really compressed. Cap rates are, of course, the measurement of the price per dollar of income, and you lower the cap rate, which is where we're at now, the higher the price of the asset. But in multifamily, that's pretty well done. But in self-storage, again, a lot of these mom and pop owners, and there are about 25,000 of them out there, 25,000 facilities in the US, they have tremendous upside they don't take advantage of. And there's a lot of examples of that. For example, an expert operator going into a self-storage facility can add U-Haul. You can rent U-Haul, you get a contract with U-Haul, and you can add, let's say, $3,000 a month in commission with no capital expenses out of pocket. Let's actually just play that one out. So Danny, if I added U-Haul $3,000 a month, that's $36,000 a year in added revenue to the bottom line. And since there's no significant expense with that, it's commission. And if you've already got an employee there anyway to sweep out the truck, now you're adding 36,000 to your profit as well. Well, the magic value formula in commercial real estate that I touched on earlier is this. It's the value, or the change in value, is the net operating income divided by the cap rate. And so again, the cap rate is the capitalization rate, the rate of return unleveraged that an average investor would expect for this type of asset in this condition, in this location, at this time. So that's the cap rate. Cap rates used to be about 10%, let's just say on average, but now they're running closer to 5%. And in areas where you are, it might be closer to 4% to buy a property. Let's just keep that number in mind. Let's just use 5 or 6%. So $36,000. Remember, the value formula is the net operating income, or the change in it, divided by the cap rate. So $36,000 you add to the bottom line. That sounds really good. but you divide that by a cap rate of 5%, you just added $720,000 in value to that facility. Now, if you bought that facility for $3 million and it was $2 million in debt plus $1 million in equity, you just added 72%, 720,000 on top of the million cash you put in, just by signing and implementing a U-Haul contract. Now, that's an incredible value add for investors. There's also ancillary income opportunities like selling locks, boxes, tape, and scissors, selling insurance, bringing rents up to market levels, charging tenants late fees, charging tenants based on modern software, using modern software like they do at hotels or airlines. I just changed my rental car reservation a few minutes ago, made up what I thought was a minor change, and they went from $130 for 2 days to $311. And they got me, right? Because I'd already paid up front. Well, that's what it is. That's how it is with self-storage a little bit as well. Think about this. If I was renting $1,000 apartment and they raised my rent by 6%, I might think, well, that's $60 a month. It's $720 a year I'm locking in for. I might leave. But if I'm renting a self-storage unit at $100 a month and they raise my rent by 6%, I'm probably not going to spend a Saturday, get a U-Haul, get my friends together to move all my junk, my treasures down the street just to save $6 a month, especially when I'm on a month-to-month lease and I'm thinking, I'm going to be out of here in a few months anyway. And so this is a powerful strategy that self-storage facility owners can use to capture inflation as well. Think about it. If I own an Amazon or an Amazon warehouse or industrial facility with a 10 or 20-year lease, I'm already locked in. When inflation hits, I'm not going to be able to capture that. And so I'm, actually the tenant's getting the best end of the deal. But with self-storage, everything's on a month-to-month lease. So I can inch up the rents several times a year and capture that inflation, especially if I have a well-run facility with good marketing, good occupancy. Let's say I'm at the 90-95% occupancy level. Raising the rents by 5 or 6% can, using that same formula I mentioned earlier, can increase the profitability and the value of the facility by 20%. Literally a 6% income increase can lead to a 20% increase in returns to the investors. Very, very powerful.
Yeah, it is really powerful. When buying these and looking at current cap rates, knowing that sort of thing changes over time with the economy and everything else, is that sort of a way that, do you look at that as more of a more of like gravy or the cherry on top, sort of, you still buy at a better, but when you're adding that value, you're not buying, assuming that you're adding all of that value and they're willing to pay up to that because you're going to do that, right?
Yeah, I know exactly what you mean. Boring investors look for cash flow first. And, Warren Buffett said, unless you learn to make money while you sleep, you'll have to work until you die. And so our goal is to create true wealth, which is, in my mind, assets that throw off predictable cash flow. So that's our first goal, like you said. Secondarily, though, we're looking for those value adds. And we work with operators who've been doing this long enough, and they have teams in place that they can recognize the intrinsic value. And if the intrinsic value is much greater than the extrinsic value, the price, then, and the intrinsic value being value add opportunities that are not tapped by the current owner, like the U-Haul example. If they see that, sometimes they'll pay a low cap rate for a property, especially if it's mismanaged. You've heard of Beeville, Texas, I'm guessing. We invested in a self-storage facility with about 600 or 700 units in Beeville, Texas. And it was terribly mismanaged. There were 5 siblings that were fighting, and they sold the property. Our operating partner bought it for $2.4 million in cash. He turned it around, and in just 4 months, he was able to get it an appraisal. And remember, he bought it at 2.4 cash, no debt. He was able to get an appraisal of 4.6 million
Wow.
just several months later. He financed it for the first time at 2 million. And then when he sold it a year after that for 4.6 million, the investors, who only had about $500,000 in the deal, walked away with $2.5 million.
Yeah.
And so that value add was quite predictable because he could see a lot of the upgrade potential. And as far as the sellers go, they actually got a fair price for what they had because it was pretty mismanaged. There was no website, no marketing, no U-Haul, no, ancillary sales to my knowledge. And so those are the kind of things we can, they're pretty predictable. They're not just gravy in some cases.
So what are the improvements, the value adds that tend, in your experience from the deals that you've done, to bring the most your cash flow and value with the least amount of cost and work? I mean, you mentioned U-Haul, right? But what are the other ones that you see a lot with the mismanagement? So mismanagement could mean a lot of things. Which areas of mismanagement do you actually like seeing because it's very easy to fix?
Yeah, so we've got their stuff and there's no eviction moratorium. And so if they're late payers or they're not paying, that's a really easy one to fix because we're leveraging the value of their own treasures in our units. And so when we invested in a Grand Junction, Colorado self-storage facility that had 80% occupancy, but it also had 80% delinquency. So 80% of the people were paying late or not paying at all. Well, those were two problems that were pretty easy to fix. First of all, we implemented marketing and we began to get toward a 92% occupancy. That is a huge value add. It might not sound like a big one, but it really is. I mean, we cut the vacant units in half, but more importantly, we eliminated the 80% of non or late payers. We immediately set them straight. Our operating partner did, and got that delinquency down to the normal level of about 5%. So there's two value adds right there that we really like. I mentioned U-Haul. Another one is adding boat or RV storage. Boats and RVs are obviously very popular right now during COVID and beyond. And so graveling or paving a section of vacant land out front or out back can bring a lot of profits as we make room for opportunities like that. Adding climate controlled self-storage, you can get a 1980s facility that has, let's say, a couple hundred non-climate controlled units. And if you have even a half an acre available on that property, you can sometimes build a climate controlled building. It will increase the image of the facility, especially if it's by the road, because you've got this beautiful 3-story building in front now. It will dramatically increase the profitability. There's no land cost because you've already got the land. This is just a real win-win a lot of times. Now, self-storage has been one of the less expensive and easier, more predictable things to construct in the past. Right now with COVID, like everything else, it's getting a little tougher. So that's another value add. Adding showrooms with locks, boxes, tapes, scissors, the chance to meet somebody in a nice environment, possibly upsell them to a better or a larger unit. Late fees in selling insurance, those are other value adds. Even having a cell tower or a billboard or a propane station or an ATM on the property, those are 4 additional different kind of value adds that can significantly increase income, and therefore the return on asset and return on equity can sometimes go through the roof with these. One thing I love right now about self-storage, like everything else, Fannie Mae and Freddie Mac and others have really recognized this as one of the darlings of commercial real estate. So our operators are getting loans, like fixed rate loans in the like 3% range for 10 years, sometimes with, all interest only, for all 5, let's say 5 or 10 years interest only. So that historically low interest rate, coupled with the chance to capture inflation, is a tremendous hedge against the inflation we're seeing in the US right now.
No, that's a good thing to go into here then is, especially because of the pandemic and all that kind of things. How did self-storage fare in that? And or, also what are
Mhm.
the risks and downsides that people don't anticipate?
Yeah, so I'll answer those separately. There's a bunch of risks, but the self-storage, like everybody else, we were really nervous back in the beginning of the pandemic. The first thing we saw in March of 2020 was a whole lot of college students had a lot of uncertainty. So they started moving their stuff out of their dorm rooms. They didn't know if they'd be back in a month or if they'd be back in 6 months or ever. So they moved their stuff into self-storage. So that was an immediate boost for self-storage. The second thing we found during COVID was, well, I mean, self-storage is quite recession resistant. In good times, people are filling up their Amazon and Walmart carts and they need a place to store their stuff. In bad times, we see the 4Ds in operation. And again, these are unfortunate. I'm not making light of them, but we have death, downsizing, dislocation, and divorce. And so a lot of those things have been going on since COVID. I mean, we know there's been a whole lot of relocation, a lot of people moving, from places like California to places like San Antonio. And so when they do that, they're often storing their stuff along the way or even long term. Offices, obviously, we all know that offices have been shutting down and they need a place to store their office equipment and furniture when they end or break their lease and people are moving to work out of their homes now. Restaurants and bars shut down in record number during COVID, and a lot of those places need a place to store their stuff. And so self-storage has become truly the darling of commercial real estate. In fact, a Wall Street Journal article and a New York Times article, both this fall, talked about how self-storage has just shined since the beginning of the pandemic. So that's the answer to that question. As far as risks, I wrote an article that came out in Bigger Pockets, biggerpockets.com, a few days ago called How to Lose Money in Self-Storage. And that article talked about the various ways somebody could mess up. The number one way by far is to have an asset that is still leasing up. In other words, let's say you have 1,000 units and you've only got 100 filled, and then something big happens, like a competitor comes in down the street. We had this happen. We invested in a Bradenton, Florida self-storage facility in a very fast-growing area. Well, other national competitors saw what a fast-growing area it was as well. And right about the time we opened on one of these two facilities that we invested in, two other national competitors popped up quickly nearby. And it really slowed down the lease up for this facility and, of course, for those competitors as well. And that really slowed down the return on investment to investors. We are selling that property this week, and we're very happy with the outcome in the end, but because it hit 92% occupancy, but it took 3.5 years to get to where it should have gotten in about 2 years.
Mm.
And so that's the number one risk by far. A second risk, Danny, is viewing this as a passive business. I mean, people say, hey, I want to buy one of those self-storage and I'll just get a check in the mail every month. Well, that makes you a mom and pop operator. And that's a great one to target as an acquisition for companies like our operators. But, it's not, it's a real estate operation, but it's also a retail business. So it's kind of both. And to have the skills and the expertise and the time commitment to do that well is a lot more than a passive business. So some of the folks who think it's a passive cash cow find out that they're wrong. A third risk would be investing with a bad operator, somebody who's a newbie and who may have overpaid, or they may not have the operations and marketing team in place to maximize income and create value. A fourth risk is actually, this is really obscure, but it happened to us once. Our operating partner bought a facility and found out that the seller had significantly inflated their books by having a bunch of false rentals on the books. And so it took him quite a while to fill those empty units that suddenly became vacant the week after he bought the facility. And nobody was there to clean out their stuff because these were actually names of friends and family who were on the books, but they were used to inflate the numbers when he bought. And so that would be something to look out for as well. The last risk I would tell you is investors need to use Radius Plus. Radius Plus is an app that allows you to check the location. You want to be in a location where the self-storage density is not too high. For example, in Texas, you might see an average in your area of maybe 8 or 10 square feet per person in a 3-mile radius. And so if you look at a location, look at 3 miles around it, you want to see less than 8 or 10 square feet of storage per person. If you see 20, it might be overbuilt. If you see 2 or 3, like we did when we invested in Minnesota, it might be undersupplied. And that's what we really look for in these types of facilities.
Oh, that's a cool tip. Yeah, I was wondering about that. How do you know for sure? I mean, without physically driving and looking and calculating that kind of thing manually. That's really
Yeah, you
cool.
need to do that too, though. I mean, because you want to be on the ground and check that radius yourself in addition to using Radius Plus.
Yeah, helps you make some preliminary decisions and then move forward and do the due diligence. Right.
Yeah.
Cool. So I would think that, that there's some reasons why investors wanting to move from, or even just add to what they're doing in residential real estate into self-storage, have some different concerns about how easy that is to get into. In your opinion, what are what is it really like transitioning into that? I mean, what are the ways to do that, to make that transition?
I personally, after striking out enough times myself, like I mentioned earlier, I personally believe everybody should find a lane and stay in it. And so if you're really, really good at house flipping or, rent to owns or short-term rentals, stay in that lane and then use some of your profits to go out and find a great operator who you really trust, do the due diligence on them, and then invest heavily with them. It's not easy to be an expert in everything. And in fact, again, it goes back to that boring investor thing. Once you're bored with your business, you're probably just where you should be, making a nice profit and having enough profit to invest passively. So my first advice would be to find a passive investment opportunity. There are a lot of self-storage companies out there who are syndications or like ours, which is a fund, and we take investors' money and we put it in the very, very best deals we can. So I'd recommend people do that. I am a little biased, but I will tell you that's how I invest myself. I mean, I wrote a book on self-storage and it just came out from Bigger Pockets about 2 weeks ago, but I wouldn't dare own and operate a self-storage facility myself because I don't have the team, the track record, and the technology to do that. So I would really recommend that people outsource to an expert. Now, if you sold your company or if you're bored with retirement or if you just quit your job and you want to be a full-time self-storage operator, first of all, get my book. It's called Storing Up Profits. And then go to some masterminds, get involved, really learn the ins and outs of self-storage facility operation. And then there are basically 4 different strategies you can use to build a self-storage empire. Strategy number 1 would be buy and hold, just an existing operation. That would be my least favorite. That's what the institutionals do. They're just looking for steady cash flow, like I mentioned earlier. Strategy number 2 would be to rehab an old building. You might find an old Kmart or Sears or Toys R Us building, or like my friend AJ did, even an office building, and rehab that and turn it into a self-storage facility. My friend AJ, speaking of him, he actually was on a podcast July 4th or 5th, 2018. I'll never forget it, on Bigger Pockets, where he talked about taking a super Kmart in Reno, buying it, selling off the parking lot for the most part to apartment investors, apartment developers, and then cutting the building in half and turning it into a high-end climate-controlled self-storage building.
Oh, wow.
He only had $7.5 million in this project. That was 2.5 cash, 5 million in debt. And he actually sold it. No, he didn't sell it. When it was 40% full, he actually got an offer from an institutional investor in the high 20s, like 26 million.
Wow.
This would be 9 times profit on his equity. And he turned it down because he knew he could do better. And so rehabbing an old facility, or repurposing is what I should have called it. A third strategy would be to be a ground up developer. This has the highest risk and the highest potential return or potential loss. And that's just doing a ground up self-storage facility. And then the fourth, which is my favorite, which would be your traditional value add. And that's what we've been talking about on a lot of this podcast, where you buy an underperforming mom and pop facility and then bring it up to professional standards. And then the fifth strategy would be to do any of these, put together a portfolio of those, and then sell the whole portfolio to an institutional investor for a premium. And that is a fabulous way to build wealth. There's a lot of people, I mean, Blackstone and Public Storage and Life Storage, Simply Self Storage, a lot of these folks have been bought and sold. And these REITs that are buying up portfolios of assets. We were involved in a closing like that just about a week ago, where a large private equity firm recapitalized 26 self-storage facilities. And we had one of those that we were investing in. And it was a very nice day for our investors.
Oh, wow. Nice. Well, yeah, you've covered a lot, man. This has really been informational and got me pretty excited about self-storage. And I'm sure that people listening out there, and I'm definitely going to check out the book. You said it was Storing Up Profits.
Yeah. I don't have the book handy, but this is the image of the book. I got it from Bigger Pockets yesterday. It's Storing Up Profits, Capitalize on America's Obsession with Stuff by Investing in Self-Storage. And
Very
I
cool.
just got this canvas. I'm just so tickled. My wife yelled at me. She said, "You won't believe what came in the mail." So anyway.
I love it. It's cool. It's a good cover.
Thanks.
All right. So everybody out there listening, yeah, head over and it's probably on Amazon. Yeah.
It's on Amazon Audible right now. And then by mid-December, December 14th, it will be released in paperback on Amazon.
All right, cool. Well, thank you so much, Paul, for being on the show and sharing everything, all your experience and wealth of knowledge. And I really like that you included some numbers. Sometimes people will talk in a vague way about, use this app to do this. Well, it's like you said, use this app and then look for this, right? Here are some numbers to go off of. So I thank you very much for going into detail on those things. And
absolutely.
Yeah.
Thanks, Danny. I really appreciate it. I do have a special report if people aren't ready to buy the book.
Sure, yeah.
You can get a special report just as a primer for that. It's at wellingscapital.com/resources. That's WELLINGS capital, wellingscapital.com/resources. And you can get a free special report on self-storage investing, another one on mobile home park investing, and a whole lot more.
Awesome, man. Thanks for sharing that. And everybody listening, check that out as well. It's really cool of you to offer those up. All right, Paul. Well, have a great day. It was good to talk with you today.
You too, Danny. It's been great being here.
All right. Take care.